Hey financial fans, welcome back to another stock analysis. Today we'll be covering Citigroup stock ticker CITI. Citigroup is a multinational financial services company that offers a wide range of financial products and services to individuals, businesses, governments, and institutions around the world. Citigroup operates through several business segments, including global consumer banking, institutional clients groups, and corporate and others. The global consumer banking segment offers retail banking services such as credit cards, personal loans, mortgages, and wealth management products. This segment also provides commercial banking services to small and medium-sized businesses. The institutional clients group segment provides investment banking and trading services to institutional clients, including corporations, governments, and other financial institutions. This segment also offers treasury and trade solutions as well as security services. The corporate and other segment includes certain unallocated costs of global staff functions, other corporate expenses, and businesses that have or will be exited. Citigroup is one of the largest banks in the world, with operations in more than 160 countries and jurisdictions. Its mission is to enable progress and economic growth, and it strives to create economic value for its clients, shareholders, and communities it serves. They are currently sitting at a market cap of $86 billion, and in 2022 they generated a revenue of $101.6 billion, and the dividend yield is currently sitting at 4.61%. 63% of their revenue comes from the institutional clients, and 37% from global consumer banking. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company, and we'll be using a standard margin of safety of 25%. That can never be below 0%. The margin of safety can either increase or decrease by the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction. When we're using 3 colors in a scale, bright red will mean a 5% increase, orange will mean no change, and bright green rather will mean a 5% deduction from a margin of safety. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone up over the years, going from almost $8 billion in 2012 to $18.8 billion in 2022. The average EBIT growth was 21.7% annually, meaning a 10% deduction in the margin of safety. The margin has also gone up, going from 11.11% in 2012 to almost 25% in 2022. The average margin growth was 20.7%, meaning another 5% deduction from a margin of safety. The next two ratios are the dividend growth and payout ratio. The dividends have also gone up over the years, going from 1 cent, which was determined after the financial crisis in 2008, the dividend yield was set at 1 cent. And it increased, going to 51 cents a share in 2022. The average dividend growth percentage was 19.2%, meaning a 10% deduction rather from our margin of safety. And this is with a payout ratio sitting at a very low 29.2%, which is a 5% deduction in a margin of safety, because with this low payout ratio, we can see that they still have a lot of room left to increase their dividends further. Final two ratios that we'll be looking at are the debt to EBITDA and assets under management CAGR. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of EBITDA it takes for the company to pay off all of their debt. As you can see in the top left corner, the debt position of Citigroup is currently smaller than the cash position, meaning that they can pay off all of their debt just using their cash. This indicates a 0% debt to EBITDA ratio because they have no net debt, which is a 5% deduction from margin of safety. The next metric is the assets under management compound annual growth rate. And as we can see, it has gone up, going from $494 billion in 2017 to $861 billion in 2022. This CAGR here is then almost 12%, meaning another 5% deduction in the margin of safety. Looking very good so far for Citigroup. Let's go look at the valuation models next to determine the intrinsic value of the stock. The first valuation model that we'll be using is the dividend discount model. I've imported the dividend payouts of Citigroup going from 2018 to 2022. The average growth rate in dividends during this period was 3.33%, and I'm projecting an expected growth rate in the future dividends of 3.5%. I will be using a discount rate of 9% in this valuation, giving us a dividend discount model price per share of $38.39, which is a 13.24% downside out of this model. The second model that we use is Graham's Vice Valuation formula. In this model, we look at the earnings per share that Citigroup is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds, always sitting at 4.4%. And we go by the theory that a company of no growth is always sitting at a PE of 7. And looking at all of these metrics, we get a Graham's price per share of $52.14, which is a 17.83% upside out of this model. The third model that we use is the multiple valuation. This model we look at similar companies to Citigroup, look at their stock price and their earnings per share. This way we can determine the average PE multiple in the industry, which in this case is sitting at 10.14. All we have to do to get a fair value out of this model is to multiply by the earnings per share that Citigroup is generating, which is $7.11 a share, giving us a multiple valuation price per share of $72.11, which is almost a 63% upside out of this model. The fourth model that we use is the price to tangible book value. In this model, we look at the same companies that we looked in the prior models, and we use the price to tangible book value. The price to tangible book value is a good valuation metric for banks because it provides investors with a sense of how much they are paying for the bank's tangible assets, such as loans, deposits, relative to the market's valuation of the bank as a whole. The average price to tangible book value of these two banks is sitting at 1.28. Doing the same for Citigroup, we get a price to tangible book value of only 0.54. This gives us a price to tangible book value price per share out of this model of $103.92, which is a massive 134.84% upside out of this model. And the last model that we use is the cost to income ratio. We will once again be doing this for the same companies that we used in the prior models, and we will be calculating the cost to income ratio. Cost to income ratio is a good valuation metric for banks because it measures the efficiency of a bank's operations by comparing the cost of running the bank to its income generated, in this case with its interest income and expenses. The average of these three banks is sitting at 27.75%, and doing the same for Citigroup, the cost to income ratio is sitting at 34.59%. This is, of course, meaning that it's currently a little bit more overvalued in relation to the other banks on this metric. And this gives us a cost to income ratio price per share of $35.49, which is a 19.8% downside out of this model. If you want to get access to all of the models I use in my videos and more, you can check in the description for my Patreon link. Anyways, getting that self-promotion out of the way, let's go look at a final overview of a valuation next. Looking at our final overview, we've imported the discount dividend, Graham's valuation, the multiple valuation, the price to tangible book value, and the cost to income ratio price per share, giving us an average of $60.41. Our margin of safety we've determined earlier using a standard margin of safety of 25%, deducting 10% for the EBIT growth, deducting by 5% for the margin growth, 10% for the dividend growth, 5% for the payout ratio, 5% for the debt to EBITDA, and 5% for the assets under management CAGR, scoring the maximum deduction in a margin of safety on all of the metrics that we use. This gives us a margin of safety of 0%. And of course then, the fair value is the same as the average out of all of our models. And with the current price of $44.25, we get an upside out of our valuation of 36.52%, indicating that it's currently a buy. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments. And thanks for watching.